up, guys? It's day 9, and today we're talking about liquidity. We're going to talk about liquidity, types of liquidity, and we're going to incorporate liquidity trading concept into what we've already done so far, how we can combine both liquidity and the break and retest that we've all been talking about all this while. All right. So without wasting much time, let's get right into the lesson. All right. Let's get right into the class. Now, what is liquidity? Liquidity is a pool of orders. This is where there's so many orders, and price tends to take out these orders to fill larger orders. So price uses these orders, pool of orders, as liquidity. When they get taken out, the larger orders are filled. So this is what I mean. I'm going to explain it simply with this. So let's say this market is moving this way. So price is moving this way, and believe me, traders are actually selling this market, putting their stops somewhere above here because they believe price is going to go down. They put their stop, they put their limits. They are selling from this price level. That's why you see price pushing down, and they put their stops above the highs of where they are selling. So this is what market does. Market takes out these stop orders as liquidity to fill large orders, then move in their direction. So it's just like market grabbed liquidity, took out all their stops orders, these people that were selling when price. This is like price market moves this way to make them believe that this is the real move, but this is not the real move. All right, this is just the move to actually make them put their stop orders above these highs, right? So when the real move wants to happen, that means if the real move wants to happen, we have to fill larger orders for the real or large moves to happen. So market comes back to take those orders, all right, and fill the larger order, then drops, right? So basically this is what liquidity, same way it happened here, it also happens like when you're trying to buy. Traders trying to buy here are putting their stop losses below these lows, right? So what does market do? Market comes to take those stop orders, filling a larger order, then moves, right? So all of these are just like an inducement. Market just try to induce traders, making them think that this is a real move where they get in trying to buy the market, and price move for a short period of time, then comes back, take out their stop losses, and after taking that, price fills a larger order, then moves in their intended direction. Now, there are type of liquidities, right? We have inducement, we have engineering liquidity, we have trend line, we have range liquidity. So I'll be talking about all of these type of liquidity separately, but we are going to start with range liquidity, all right? Because in range liquidity, we have inducement and engineering liquidity. Like all of these are just um, you know, types of range liquidity, right? So now, if you remember, market moves in three phases. We have the impulse, the break structure, we'll have the correction, all right, and we'll have the continuation. Now, if this happens, it doesn't just happen plainly like this, all right? It forms structure. Let's say market break structure. Before we have that break of structure, we'll have series of higher highs and higher lows, all right? That forms break of structure while we consider this as our impulse. Then when market wants to reverse, we usually have a break of a recent low, all right, the market pulls back as correction, then drops. So when market start forming like this, we can see that the correction has already started, right? And this correction continues back to say we hit a key level. Then once we hit a key level, then it gives us a sign again that it wants to continue going up. Then we'll start pushing up again, all right? So this is basically how the market moves. Impulse. In this impulse, we still have like a minor trend. If then correction, in this correction, we still have like a minor trend. Continuation, we still have like a minor trend, all right? So but basically we are categorizing them into three movements, right? Which is impulse, correction, and continuation, right? Now on this particular leg, all right, which is the impulse leg, we'll have minor structures, right? Those minor structures now create highs and lows. In the case of an uptrend, we have this, right? We have this. So market is creating a minor trend. All of these highs and lows, these lows, right? So the highs are the ones being taken out, breaking structure. But you can see that the lows are always protected till price changes um, direction and start dropping. And you can see whenever we have that change of character that actually starts pushing price to the downside, or that starts the correction phase, right? You can see that the this correction targets this low. All of these lows are taken out. So all of these lows being taken out are liquidities, right? Because when traders that were buying on this phase, all right, so they buy here and their stops are below this low. They buy, can see they were buying. That was the reason why price was pushing up, right? Because they bought, and once they buy, the stops are always below. And during this correction phase, you can see that the movement targets, these their stop loss is taking them out. So all of this occurs in a range. So every liquidity you find in a range is what we call range liquidity. We have um internal range liquidity and we have external range liquidity, which is IRL. Internal range liquidity, we have external range liquidity, right? So internal range liquidity are the one that occurs inside of the range, right? While external is the one that happens outside of the range, right? So we have this. So this is the impulse that brick structure. We have all of these as our what? Range liquidity. All of these are internal range liquidity because they are within the range. Remember, we confirm range when market breaks structure, which is the impulse will confirm our protected low. And once we start shifting structure to the downside, we'll confirm our range high, right? See, market completes the correction phase and start going up again, then we'll target the range high. Now, this range high is our external range liquidity. All right, is our external range liquidity. Why these and these that happens here, our internal range liquidity. All right, now inside internal range liquidity, we have inducement. Inducement. All right, we have inducement and we have engineer liquidity. Now we're going to go back to our writings previously. Now inside internal range liquidity, we have all of this engineer liquidity, trend line and others. In inducement, we have inducement inside of remember we started with range liquidity, then we said we have internal and external range liquidity. Now talking about internal range liquidity, we have inducement, engineering liquidity, and trend line. Then we're going to come back to external range liquidity. Now for internal range liquidity, inducement is the all right. So inducement is that an internal range liquidity that is closest to your POI. All right. So if we have something like this where market break structure and this is your POI, right? This is your POI. Let's say this is your POI. This internal range liquidity that is closest to this POI is your inducement. So what is inducement? Internal range liquidity that is closest to your POI, right? So then for engineering liquidity, now engineering liquidity is same thing, almost same as inducement, all right? And this happens when we have something like this. Cases where market forms something like this, we have no sort of internal range liquidity and we have our POI, right? So this type of POIs are called two clean POIs because there's no inducement or internal range liquidity close to them, all right? And for market to move, we need to grab liquidity, all right? We need those stop orders to be taken out so the large orders can fill and market can move in the intended direction, right? So in this case now where we have no internal range liquidity or rather inducement that can induce traders and then take them out for price to move from this particular POI, look at what market does. All right, it's engineers liquidity. Is either it taps into that POI then buys, all right, inducing traders that this is the real move. Then after moving for a short period of time, then it comes back taking out that the stop loss orders of those traders and finally moving. You can see in this case now, this inducement was not from here. It wasn't from this part, from this impulsive leg. This was from the correction leg, right? So for inducements, you have to say inducement from the impulsive leg, right? Why for engineering liquidity, it happens on the correction leg when there's no internal range liquidity on the impulsive leg. So market for price to still maintain this particular POI, except it doesn't want to maintain it, all right? Which in in that case, it will have to like take out this POI, take it out like this, right? So in cases where it wants to maintain that POI, let's say that is a very strong POI, and price doesn't want to like go below this POI, it wants to maintain structure, right? So this is what price do. On the correction phase, it creates a move that induces trader, inducing them that this is the real move that price has started moving up. So some traders are going to buy, thinking price has started moving already, whereas this is just an engineer liquidity that price is going to come back later to take before the real move happens, right? So that's that for engineering liquidity. So you just have to know something. Inducement happens on the impulsive leg, engineering liquidity on the correction leg. Now, there's another type of engineering liquidity where it doesn't happen this way. All right. I'm going to give that example in a bit where we'll have market break structure. This is impulse, right? Now, on this impulse, price tries to come back to mitigate the POI very close to it, but doesn't, breaking another structure. So let's say we have a POI here. You can see on this correction, price was supposed to mitigate a real level, a key level to buy, right? But it didn't. It just came very close to that key level and started buying. So this move was just engineered by former traders who thought price has already missed the POI and has started buying. So they are going to jump in on this trade trying to buy, all right, because they feel like they've missed this move and price did not mitigate this POI. Remember, the key level of the POI still has to be unmitigated. So look at what price does. Price comes back and takes out this low. So because people that were buying here on FOMO would have their stop orders below this low. So price comes back to take them out before moving. All right. So this is also engineered liquidity. This is also engineered liquidity. Oh, that was hard pronouncing. So this was also engineering liquidity, and yeah. So we've done inducements, engineering liquidity, now trendline liquidity. Now trendline liquidity, I think I've explained this before during our class on break and retest. This is where we have price give us an impulse, then on the correction phase, it forms a trend, right? It forms a trend, which is the correction downtrend, um, which is the correction, right? Which is also downtrend, a minor downtrend in the overall uptrend, right? Because for us to start looking for to buy, that means price is in an uptrend. So we have something like this: price break structure, then we'll have a correction that forms a downtrend. Now this is going to form a trend, all right? So if we draw our trend line and it aligns with the trend, so for us to start engaging in the buy again to continue this move, we have to wait for a breakout of this trend line. And once price breaks it out, price also has to break structure for it to be high probability. We wait for the retest of that trend line before we start buying. All right. So if price retest breaks out of a trend line and retest, you see those highs that actually made up the trend line are going to be liquidities. So they become trend line liquidities. So whatever structure you're seeing here, this continuation price movement is going to take out all of those highs, every single high that was formed by the trend line. So price is going to take them out, and price taking them out. So this trend line here means that like their stop orders that price was creating. People that were selling during the correction had their stops above these highs. So when the correction is happening, price is definitely going to take out those orders, all right, and move in this direction, right? So that's that for trend line liquidity. Then, and everything is inside the internal range liquidity. So the inducement, the enduring liquidity, the trend line liquidity are all internal range liquidity. Then the external range liquidity is that high we target. Remember, we have this impulse, the market does this correction, creates all of those internal range liquidity. And then on this break, on breaking this high, this is the external range liquidity that price always comes for. can call it the next drawn liquidity. This is the after price has taken out the internal range liquidity. This is the next liquidity that it usually takes out, right? Which is the external range liquidity. So those highs you target, the weak highs you target in an uptrend is your what? External range liquidity. All right. So let's get to the rechart and see some examples. So this is on silver. We can even see an example right here. So we have this break, price broke structure. So obviously this is an impulse. Now look at all of these impulse has what? A trend inside of it. Let me have a trend inside of it. Look at we made impulse, correction, impulse correction, impulse correction, impulse correction. So we hit here and price started reversing. Price broke this low and started reversing. So we have our impulse that broke structure and price now is correcting back to a key level, right? So and here on this POI, this is an extreme order block POI, and on this extreme order block POI, this is the range liquidity, internal range liquidity that is closest to this POI. All right, so this becomes our inducement. So this is the structure, price break structure, sorry. So price does something like this, break structure. So this internal range liquidity that will have closest to our POI, right? So this becomes our inducement. So we'll have to wait for price to come here, then we'll buy, and that's it. If you also want to use the break and retest method where you have to wait for confirmation, fine. But if we're to take this trade now, this is where we'll be taking the trade. Our stops on the this protected low, then we target the next drawn liquidity, which is the external range liquidity, which is this high. But in this trade now, if I want to use the break and retest pattern where price mitigates, price has given us impulse already, this is correction, so we'll have to wait for that market structure shift to continue to buy on continuation. Now price mitigated a key level, all right, sweeping liquidity, prints a higher low and break. All right, this was where we had the break. All right, now where is our next buy point? Price to retest these points, the higher low that was broken, that is our POI. Now we've had a structure break. This was the last high that was printed. Price has now gone to like break it. All right, so we are waiting for a retest into this level. So let's see if this aligns with trend line too. So if you can see from this was a high, a high, a high. So this also aligns with a minor trend line on the lower time frame. Go to 30 minutes, you're going to see this clearly. So I'm waiting for price to mitigate this level. Our stops below the higher low. Then we can target highs here and even more, right? So this is for the inducement. Then for the engineered liquidity, so let's look for an example on engineered liquidity. All right, so I think we'll have one. All right, so here we have a break, right? This is impulse that break structure. Now this is the correction, right? Now we'll have a key level here, and this is our key level. You can see price has reacted off of this particular zone. But look at what price is. This is a two clean POI or on the impulse. We'll have our key level, our POI already, but there's no inducement. All right, there's no inducement on this POI on the impulsive leg. Now look at on the correction leg, price came very close to that POI but did not mitigate it, creating a false move. All right, so people that bought on FOMO, they are the ones that created this move, that engineered this move, right? But look at what price came to do. Price came to take out their stop losses, which is at this level, and that was when the remove happened. So this example I gave on engineered liquidity, where we'll have a breakout structure, there was no inducement, price taps into a key level very close to it, moves Then the FOMO traders engineers this move, then price comes to take them out before moving. Yeah, grabbing liquidities here. So this is where we'll have the POI. That's exactly the same thing that happened here. We'll have engineering liquidity playing out perfectly fine. Put our stop loss at this higher low. Then we target this high, right? So that's for engineering liquidity. I also gave a second type of that engineering liquidity. And yeah, I think it's gonna be here. So we'll have this. I'm gonna clean here. Control. Okay, I think we'll have the same thing here. Price, broke structure. This is impulse, right? And we have this as our POI. This is our higher low POI, right? But now price broke structure printed this move that came very close to the POI, but we did not mitigate the POI, and we had another impulsive break. What the price do? Price came to take out the you know the liquidity before we had the remove. This was the second framework I actually explained, where we'll have something like this: a break of structure. There's no inducement, price engineers liquidity very close to the POI you want to buy from, then moves, right? Then afterwards, price comes to take out that engineering liquidity before moving. That's exactly what happened here on silver. This is on silver, a stop loss here, and yeah. So you can see this is not the real move. Price came to take out liquidity before the real move happened. So the another one is trend line liquidity, and I think that's also here. So you can see we have a trend line liquidity here. So this is like an impulse on the higher time frame, correction, then continuation. So I want to break this down and see what price actually did here, because we had a trend line, right? So we had a trend line from here. Yeah, we have a trend line. You can see we had this touch here, 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 here. See, price finally broke the trend line. Then this was where we retested and price started moving. Now, after we started buying from here, look at where price targeted. This high was taken out, this high was taken out, this high was taken out. This external range liquidity was also taken out. You can see, so once trend line liquidity, once a trend line gets broken and retested, all of those highs that forms a trend line will actually be liquidity, which is the trend line liquidity. So price is definitely going to, take out all of those high that was made during the, formation of the trend, right? And that's a typical example of what happened here. So trend line as a type of liquidity, you've seen me explaining with this particular structure. All right. So that's that. We've done inducements, ensuring liquidity, the two types, then trend line liquidity, which I've shown you here. So if you had entered, used trend line break and retest on this particular trade, entering on the retest of the trend line and your stops just below this protected low, and you're targeting the external range liquidity, which is this high, you'd have caught a 1:6 on this trade. All right. So that's basically we've done. External range liquidity is that high, like when we have an impulse, then the correction. So your range high is always your external range liquidity. This range high that you're going to target on the continuation, that is your ERL, which is external range liquidity. So that's where you always target. So the liquidity you find during the impulse and the correction is your what? Internal range liquidity. And inside of this internal range liquidity, we have inducement. All right, we have the engineering liquidity. I gave two examples on this one. Then we'll have this one here, which is the trend line liquidity. So I'm just going to call it CL. All right. So I hope you learned something from this class. And yeah, this is all about liquidity and how I, put together liquidity trading concept and break and retest to trade both of them. All right. So that will be all for this class. And I'll see you guys in the next class, which is day 10.